Okay, good morning, everyone, and thanks for joining the NCGA Economic Update for this quarter. You are welcome to type comments or questions into the chat box at any time as I'm going. I'll try to keep an eye on those so that way if there's a question relevant to where I'm at a certain time, I can just go ahead and address that then. And otherwise, there will be some time for questions at the end. Everyone should be muted right now, but at that time, when we get to that point, if you want to just raise your hand on like the Zoom raise your hand feature, Jeremy can unmute you so that you can ask your question at that point. So with that, I will get started. First thing that I was going to talk about is where we're at on harvest progress. I think that's what's on everyone's minds right now as we are in the midst of harvest and things are really rolling. The USDA report that came out on this past Monday as of October 15th showed that, U.S. corn harvest is 45% complete. That compares to 34% last year and 42% for the 5-year average. So one thing that I noticed, though, as I was looking at where the states are individually was a trend. And so what I'm showing here are the states. The top numbers represents the 2023 harvest progress, and then that bottom number represents the difference from their 5-year average. So the trend that I was picking up on, aside from North Carolina, if we look at the states that are west of the Mississippi, all of those, except for Missouri, that I'll show here in just a minute, are running ahead of their 5-year average pace, whereas Illinois and Missouri are right at their 5-year average pace. And then when we look at the eastern half of the Corn Belt, the majority of those states, again, aside from North Carolina, there are running behind their 5-year pace. So as a whole, the United States ahead of pace. But we can see a clear regional difference here as we look at that. And then, of course, as would be expected, we see that as we move from the north to the south, notice that the percent that has been harvested in those states increases. Like I said, as would be expected, our southern states get started earlier. They're farther along in their progress. And so that was kind of just where I wanted to start out today. I'll be covering the United States corn supply and demand, looking at what USDA came out with last week, also looking at the world supply and demand side, focus on digging in a little bit to cost of production, and then some of those macroeconomic factors as we look ahead here for the rest of the year. So on the corn supply side, USDA in their October World Ag Supply and Demand Estimates report, or WASDE as I'll call it, they made an adjustment to lower beginning stocks by 91 million bushels. And that was an expected adjustment. On September 30th, the USDA came out with their quarterly stocks report. And so that indicated that this change was going to be needed. And then when we look at the acres, there were no changes to acres in October. We saw some big changes, increasing acres earlier in the year. And I should back up and say here that first explain what I'm showing. The first column here is the initial estimate. So this is where USDA started their projections for the 23-24 marketing year. And then the second column represents where they were at in September. The third column represents that October estimate that we just got last week. And then there's two columns that show the October change from the initial and then the change from September. So hopefully that's a little more clear as I move through these. On the yield side, USDA did reduce the projected corn yield for the U.S. from 173.8 bushels per acre down to 173 bushels per acre. One thing I wanted to note is, since that initial 181.5 projection, we've seen yield decline 8.5 bushels. But the other times that in earlier reports where we've seen yield decline, we've also seen an increase in acres. So, this October report is different in that we have this decline in yield that was not offset by an increase in acres. Those planted acres are probably mostly locked into where they're at this point. And I just wanted to note, so we actually did see some movement on the production side, more than what we've seen, in some of those other reports. And so we saw 70 million bushel decline in production, and ending production as currently projected at 15.064 million bushels. And then as we think ahead, will there be more changes? We can consider, analyst projections, where FSA acres are, that harvested to planted acre ratio, where I'll show you more in a minute, and yields. About 2 weeks ago, I posted on the Corn Economy page an article that digs into that a little bit more, just looking at some of the historical patterns that we've seen, and when changes are normally made to those. And, it's laying out whether adjustments could be expected. And I'll also talk a bit more about that here right now. So this is showing corn planted acres, the green bar, and then the yellow bar is representing those harvested acres compared to those planted acres. And so for 2023, USDA's projection for planted acres was at 94.9 million acres. And again, we have FSA acres. Those will continue to get revised over the next couple months, but by this point in the year, those are pretty known at this point. And we have this normal pattern of the comparison between where USDA's NASS acres are relative to those FSA acres. So those are not likely to change much. We do have harvested acres at 87.1 million acres, and this is the figure that I want to focus in on a little bit more, because that we could still see some adjustment on, and so that's something I'm paying attention to. I'm going to throw up here on the right side scale the percent harvested as a percent harvested for grain as a percent of the total planted acres. I'm tripping over my words saying percent too many times there, but I think you get the idea. So I just added up again that harvested acres as a percent of planted acres. And so USDA, the current projections they have for harvested acres would make that ratio be 91.8%. And just for comparison purposes, if we look back over the previous decade, that average is 91.3%. So when we think about the year we've had in terms of drought and very large acreage number, will we see harvested acres be relatively more than what we've seen over the past decade on average? That is a question that I'm watching to see where that shakes out. Another note here is that it's not unprecedented to see an acreage adjustment at this point to harvested acres. In fact, just last year, we did see that, where the change in harvested acres from the November report to the January report resulted in a 2% drop in this ratio that I'm referring to. So I do still think that that's a figure to watch. And even with no change in yield, that could change the production figure we're looking at. And then on the yield side, what I'm showing here is the blue is the initial trend yield projection for each of these years. The yellow represents the October projection, and then the black represents the final yield. So prior to the October report last week, the projection for 2023 was at 173.8, which is higher than the 173.3 final yield in 2022. And so, one thing that I had been, I guess I should also say, before I go any farther, the bottom half of the graph here that I'm showing now represents that percent change from the initial projection to the final yield. And so for 2023, that's just using October instead of the final. But this is going to be important right here. So when we look at last year, the difference between where yield ended up and that initial trend yield projection was a 2.1% decline. And so 2023, even though this yield number that USDA has for October is at 173, when we look at that relative to where we technically could have been based on USDA's trend projection, that's a 4.7% decline from that initial trend. So even though that number is similar to last year, in a year where we had more widespread drought, and in particular across some of our larger corn producing states as compared to 2022, those yield numbers look similar. But when we think about where it was from that yield potential number, we're seeing that bigger drop in this year. Yeah, and then that's just stating what I just said. So another thing I wanted to show is looking at corn production over time. I've been hearing, I listened to several ag news outlets and have been hearing a lot, corn production potentially the third highest in history or will end up in the top 3. And so I wanted to show you visually and mathematically why that is. And so this is showing where production was estimated throughout the year until we get to the final. So the months along the horizontal axis at the bottom are representing the USDA report month and where that production figure was for that month. And so the black line with the bigger dots is 2023. And again, we are currently at that 15.1 billion bushel projection for production. And you can see here that 15.064 is slightly lower than the 15.074 of 2021. That's currently the second highest on record. And so, if we stayed at this level, we would be that third highest production on record. And when we look at number 4 there, 2017 with 14.6 billion bushels, and think about what it would take for us to fall below that 14.6 billion bushels to not be in the top 3. And this is why we're hearing a lot that, this is going to be in the top 3. That would take a 5.2 bushel per acre drop in yield with our current harvested acres, or dropping 2.6 million harvested acres with our current yield. And obviously there's combinations of changes in both that could also push to that level. But, thinking about the magnitude of those two changes, while, as I just pointed out, I think we could see some change in harvested acres. Could we potentially see some change in yield? That's certainly possible too. But to see that magnitude doesn't seem super likely. And so I think that's why we're hearing about this being in the top 3. And then I'm not going to spend time talking through this. I just wanted to show it because it's a chart that I keep updated all the time. But we've already really talked through, those changes in production and supply pretty thoroughly already. So I want to move on to the demand side. And again, I'm showing this chart that reflects that initial, the September, the October, and then where we're at relative to both right now. So looking at the 23-24 current marketing year, in this in the October report, USDA lowered that feed and residual number by 25 million bushels. And then no changes to ethanol or food, seed, and industrial in the September report. That food, seed, and industrial has come down a little bit in earlier reports from the initial estimate. When we look at the export side, USDA lowered that by 25 million bushels as well, for a cumulative of 75 million bushels off that initial estimate. And then when we look at what that means for total use, we see total use lower compared to the initial. Ending stocks have come down, and that's driven by those changes on the production side and the beginning stocks. But we see that, they're still above that 2 billion bushel level, which is, you have to really fall below that to be in what may be considered a tight supply situation. And so, there's a lot of red up here when we look at, the direction we're moving from those initial projections. But to put it into perspective, I also wanted to show where we are currently at with these October estimates as compared to the 22-23 marketing year. So again, even though we've seen some movement to lessen demand from that initial very strong demand estimate, when we look at where we are compared to the 22-23 marketing year, the projected demand for this marketing year is higher across the board. We see higher values again in every usage category and of course use as a whole. And so when we think about the potential for production in the top 3 historically, that demand is certainly needed and will be really important. And while I would love to spend time talking about all the demand categories, I'm going to be drilling a little deeper here in a moment down into exports and what's happening there, just given the Mississippi River situation and some questions I've been getting on that end. So for today, that's kind of going to be the focus here. This is that corn demand chart Again, already talked through what we're seeing in terms of increases from last year on the demand side. And then this is what I, call the total use complex here. And so, this includes a more granular breakout of that food, alcohol, and industrial category. Really driving down into all the little smaller usage within that bigger bracket. And then also brings in those DDGs, co-product of ethanol production, and the value that adds on our feed side. And again, that ending stocks number. So despite the higher demand, we see that ending stocks number going up and above that kind of that 2 billion bushel tight supply indicator. And so again, like I mentioned, I'm going to talk a little bit deeper into what we're seeing on the export side of things. And so you all have seen this graph before, but it's been updated now for this marketing year. So we're back at the beginning of the new marketing year that just started on September 1st. And so week 1 represents that week. And so draw your focus down to that bottom left corner. That solid line is the 2023-24 marketing year so far. That dashed line represents last marketing year, and then the dotted line represents the previous 5-year average. And I left that as the previous 5-year average representing 2017 to 2021, as opposed to updating it to include 22 to 23, because just to show it the more I didn't want to bring in the 22, 23. I wanted to keep that reference point to show where we had been prior to that lower year last year. And you can see that so far in this marketing year, we're really tracking along that 5-year average line quite closely. And up here in the top right corner, you can see that, that 5-year average ends up around 55 million metric tons, and USDA currently has us pegged at 51.44 million metric tons. So if we can maintain this previous 5-year average pace, we certainly can hit that target where USDA has us at. So that's something that I view as a positive. Hopefully we can continue to keep export pace and meet that. And then also exports to Mexico and exports to China. So, exports to China are trailing last year by a bit. I'm going to zoom in just a moment and show you that a little bit more clearly. I know these lines down in the bottom left are kind of hard to see where we're at so far. But exports to Mexico so far in this year are above the 5-year average and last year. And I will note that, tomorrow we're going to get another set of another week of these weekly reported exports. So we'll see where we've moved at that point. And so again, this is zooming into that bottom left corner of the previous one. I've changed the scale on the left side so that way we can see this a little bit more clearly. I'm showing the 2023-24 marketing year in those solid lines, and then the last marketing year in those dashed lines. And I also threw up Japan and Colombia because they are the next 2 largest export markets. And so if you look at, the solid lines for the total and for Mexico are trailing above last year. Those are both good. China started out above last year and is now about the same. And then we have Japan and Colombia. The solid line for Japan is hard to see because it's laying underneath that yellow Colombia line, but it is there, and both of those are also off to a relatively good start. But one thing I want to note is if we look at this right here, somewhere between I have the red circle on the solid total line along the left side of the slide. And that's kind of circling the week 4 point and the week 5 point. And the end of September fell between those. And so when we think about what our total corn exports were in the month of September, it's somewhere in that range. And so looking at this seems very positive. But one thing I want to note is that so the U.S. has started this year at a good pace, but Brazil exported 9.4 million metric tons in September. So although we are ahead of pace of last year, certainly a good way to get started. But Brazil is still, hitting the world market with a lot of corn as well. So one of the factors coming into play here is what's happening, drought impacts on the river. So this chart right here is showing the Mississippi River at St. Louis as of a couple days ago. And, we look at over the past month or so, and this is showing a blue comparison of this year compared to the brown representing last year. And so we have, we're at a lower level compared to last year. And then when we look ahead at the forecast, and I just pulled this this morning from last updated last night. This is kind of the simulation model of what's ahead for the Mississippi River. And so, it does look like that it's expected to increase a little bit over the short term, like week. But when we look out to mid-November, two of those simulations show those river levels falling quite low, down to the lower than -3 foot. And so the record low is minus 6.2 feet. So thinking about the next month, if that projection does come to fruition, the challenges that are lying ahead, as in this situation isn't over yet. I wanted to also note, while talking about river levels here, that there's also some issues in terms of the Panama Canal and getting grain movements through there. Kind of the same situation where you are reducing barge cargo weights, and then also the cost of doing so is higher. And then I've also been reading in the past week that there's some developments of similar situations in the Amazon region waterways in Brazil. And so that's definitely something to watch. To see, if that continues to progress, depending on what weather situation they have down there. With the El Nino that's expected to strengthen over the coming months, Brazil sort of has a mixed bag. It's such a huge nation that parts of Brazil that means more rain, and other parts of Brazil that means hotter and drier. So depending on what plays out in terms of weather patterns and their rainfall, I think that'll also be something to watch. They may end up having some of the same challenges that we have as well. And then, so going back to the Mississippi River, this represents barge movements on the Mississippi River going back to a year ago. So starting in October 2022 to October of 2023. And I wanted to point out here that so the bars are representing that corn, soybean, and wheat movement. And then the black line is representing the 3-year average. And so we have to go back to late May, early June to find a period where we had those grain movements at a level that was basically the same as the 3-year average. And ever since then, we've been quite a bit lower than the 3-year average of grain movements, barge movements on the Mississippi River. And so definitely concerning, especially when we think about 50 to 60% of our exported corn is moved by barge from the Midwest down to the Gulf. So this is certainly an important stream of transport for corn that is exported, and part of the reason that we're seeing some of the issues that we are. And so again, the low Mississippi River, of course, disrupts that corn trade. So this graph is showing U.S. corn export bids versus weekly barge rates. And so, back in last fall, we saw this record high barge rates at almost $106 a ton. And so fortunately, some changes have been made to alleviate a situation like that happening this year. And right now, or as of September 26th, those barge spot rates were at $51 a ton. So on the positive side, that's only about half of where those super high levels from last fall. But on the other hand, when we look at the 3-year average, those costs are normally around $23 a ton. And so we're more than double the average, the cost of getting that, grain shipments down the river. And so the problem that we're having here is that we have cash prices in those, upstream river terminals are dropping, while the cash prices at the Gulf are higher to include that increasing cost of river transport. And so I'm going to show you that as well. So right here we have, in the blue is the U.S. Gulf freight on board price, one measure of that at the Gulf. And then the gray line represents the continuous corn futures price. And then the black line, just I threw up an Illinois spot price as sort of a proxy for, maybe what farmers who are going shipping on the Mississippi are seeing at the farm level. And so, there's a couple things that stand out here. First of all, we see that Gulf price, no surprise based on everything I've just shared so far, that Gulf price going up. We've seen that corn futures contract is mostly trading in a sideways trading range between $4.60 and $5 really for the past couple months. And then when we look at that farm price, we fortunately have seen some relief, at least in this particular price figure in the last week or two. But prior to that, definitely a downward sloping movement over the last couple months as well. So again, reiterating that the price that farmers are getting has gone down, and there's not been a lot of movement in terms of corn futures price. And then at the same time, our price on the world market for our corn has been increasing, making it less attractive to those world buyers. And then looking at that again, the Gulf price compared to a freight on board price in Brazil. We did have a brief period where Brazil's price was a little bit higher, but for the most part throughout this entire, looking back to April, the U.S. price has been higher than the Brazil price at the ports. And, so it's hard to attract those exports when your price is more expensive. And certainly we've seen, we saw those prices come together in early August. And then since then, we've seen that spread grow again with US getting more expensive as kind of we've talked about. And then, relative currency values also matter. And so we've had the value of the US dollar is quite strong relative to other world currencies, including a lot of our significant trade partners and competitors. And so again, when your price is already higher, that freight on board price, and then depending on how your currency, our importers' currency, the value of it relative to the dollar versus the Brazilian real, for instance, that hasn't been helping us in terms of attracting world buyers. And so when we think about what's ahead, U.S. Treasury yields versus the value, U.S. Treasury yields and the value of U.S. dollar versus other currencies is important. And then also, like, what's that risk sentiment, geopolitical drivers. We'll talk more about that in a minute. And then actually, Fed Chairman Powell has a speech tomorrow that's really highly anticipated by the marketplace. What he will say, this will be his first speech since the Israel conflict began, and looking to that for some indication of what we can expect from the Fed going forward. And then on the world supply and demand side for corn here, these 6 nations I'm showing represent 73% of the expected production for this year. I think the big thing that stands out from what I'm showing you right now, again, so I'll note here that the first line in each category is showing the 22-23 marketing year, and then the 23-24 marketing year, and then the percent change. And so, the big thing that jumps out when I'm looking at right now is the major increase in stocks in Brazil. They had their record production last year. So coming into this marketing year, it's no surprise that they have a lot of stocks on hand. The Brazilian farmers have been slow to make those corn sales from last year because the prices that they're being offered are not positive for their margins. And, so they're kind of doing that game where they're holding on to it, similar to what we would see maybe in the US. So those are the major takeaways here. The other thing I wanted to point out is these are the black numbers here are USDA's numbers from the October report last week. But last week, China's Ag Ministry and Brazil's CONAB agency both came out with their own set of projections for their nations. And notably, China's Ag Ministry is saying China's going to produce 11 million metric tons more than what USDA's number is. And Brazil is saying Brazil is going to produce, so USDA is already calling for a reduction in production for Brazil from last year to this year. dropping from 137 to 129 million metric tons. But CONAB is actually dropping that even further to 119 million metric tons. And so, a lot to be seen left, or a lot to yet be seen in Brazil, depending on, how weather shakes out for them. Right now, they're in the midst of planting their first crop. Part of the nation does plant a corn as a first crop, but a lot of the nation is planting soybeans as a first crop and then corn as a second crop. Again, the margins have not been good for their 2022-23 crop for corn. And so, that could disincentivize some of the farmers from planting it as a second crop. And what weather allows them to do is also a factor that we'll be watching here over the next 6 months. And then, so I guess a takeaway there, just to reiterate that, if Brazil's production is even lower, their exports are likely going to fall, and of course that potentially opens up some market potential for the U.S. But also when we think about China as being the potential buyer, or one of the primary buyers of that market, if they're able to produce that much more, then their imports may fall. So we kind of have this double-edged sword, depending on some of those world market dynamics, to keep watch on. This showing the world share of exports. This is not, I've showed this graph a number of times before, but just to talk through with the latest 2023-24 projections. So the United States exports, as I've already said, are projected to increase from last year. Where that puts them is about equal to the average of the previous 5 years. Ukraine, if we jump back to that last slide, it would show there that Ukraine's actually expected to produce more in this coming year, but export less. That'll definitely be something to watch, because Ukraine has managed over the last year or two to continually find ways to export more than what everyone is expecting. So that will be something to keep an eye on as well. And then the other thing I wanted to point out is, we had this situation last year where Argentina was in, major drought, had a severely reduced crop, and therefore less exports. But Brazil had the record crop, very large exports, and more than offset Argentina's decline. That resulted in the combination of the two nations being able to export a larger share than they had in the past. And then when we look at next year, we've already talked about the potential for Brazil's exports to fall back, but Argentina, as of now, is expected to have a more normal size production and a set of exports. And so when we look at the two nations together, the combination of Brazil plus Argentina, even though Brazil's exports are projected to be lower, Argentina plus Brazil actually increases that blue and green bar together as compared to last year. So another thing to keep an eye on, again, when we think about South America's production for the 23-24 year, we are still very, very early for them to think about the weather impacts there. And so we'll keep an eye on that as time goes on. There's still a lot of dynamics to come into play that could impact them one way or another. And I want to transition here to farm cost of production. So, we're here in the midst of harvest season, but it's also input buying season. And so, as farmers are out there in their fields harvesting, also top of mind is what those costs look like for 2024. USDA actually breaks out cost of production per acre, and then their projections by crop. And so, when we look at cost of production, keep hearing about lower cost of production for 2024. And while we have seen, these bars here for the last 4 years do show some relief, and actually that's not unique to corn, it's across the board. But one thing I noticed is that the 2022, 23, and 24 bars are all quite close together. And so maybe a little bit of a relief on the cost side, but still much higher than we were in 2021. Again, we're talking about corn here, but really for all commodities, that per acre cost of production is still quite high. And what's really important when it comes down to it is not just what the cost of production is, but what the cost is relative to the price that the farmer can sell for. And so, here is showing per unit margin. So although we've seen a little bit of relief on the cost side, prices have also dropped. we tend to see, when we look back over history, that cost of production is more sticky than price. And so we see price fall quicker, faster, or farther faster than what we see those costs come down. And so, this is, certainly something that's on farmers' minds as we think about, and really underscores the importance of demand and some of those challenges that we've been talking about on the demand side. And I've been, like I said, dove down into the export side, but we will really need the strong exports in this season, and we'll continue to watch the Mississippi River levels and hope that we can regain some of that market and that value that we would normally be having, and boost some demand on that side. But just wanted to show that, and it really underscores the importance of some of the risk management tools that we have, that farmers can use. So and then, of course, when we talk about cost of production, fertilizer is definitely a big one on the minds of farmers, and especially right now, and those that potentially apply fall applied fertilizers, and because fertilizer for the corn farmer is anywhere from 30 to 40% of those total input costs. So it's a huge portion of that cost side of things. And so this, I know it's quite small here, but just bear with me for a moment. This is showing September 2008 through the present time fertilizer prices, and I'm going to expand this here in a moment. But anyway, we can see here that for some of our different fertilizer products, when we look back over time in that smaller graph, we can see that where we're at right now is actually quite similar to, sort of an average, or where we spent most of the time over the past, going all the way back to 2008. And, where we are today with prices is much lower than where we were in those 2022 peaks for our fertilizer products here. But still a little higher than where we were pre-COVID. And certainly over the last couple of years, we've faced a lot of the fertilizer industry has had supply chain disruptions from COVID, inflation, some natural disasters that impact some of those mineral where those minerals are found, and also where we've had war situations in some of our larger fertilizer producer regions, and so all kinds of things that are impacting this, and like I said, still a little bit elevated compared to where we were. I think the big thing to note here, though, is that while we had been on a kind of a declining pattern since mid 2022 across the board for these fertilizer products, we've started to see in the recent weeks a reversion, and especially for anhydrous ammonia, and then some of the others have started to follow suit, increasing. And so actually tomorrow, so I should note that these prices that I'm showing here are from USDA's Ag Marketing Service, puts out bi-weekly cost of production figures for both Illinois and Iowa. I have the longer term Illinois set, so that's what I'm showing here, but it really serves as just a proxy for what the farm price of these fertilizers are. And of course that might vary by state, but the patterns are likely to be similar. And so tomorrow we'll get the next set of 2-week info from them, and so it'll be interesting to see how that's impacted. It'll be the first release since the Israel conflict began, and so we'll talk more about that in just a second. But also want to note here that as we think about the Mississippi River problems that we were just talking about, some of our fertilizer products come in on the Mississippi River as well. So that could have some impacts as we enter the fall application season here. Just want to talk about the dependence on fertilizers as we think about what's going on geopolitically and conflicts in some regions. So nitrogen, we are able to produce a majority of the nitrogen and phosphate. Actually, we do rely on some imports of both of those products. I also want to note that the reason that the percent imported figures don't add up to the upper right corner percent produced is because we do have some exports of these products as well. So the percent imported is that import number divided by the implied usage, and then the production number divided by the implied usage. And so it's not accounting for that differential. It's just showing what we can produce as a percent of use and what we import as a percent of use. But the big takeaway here is that, you know, we in 2022 imported 99% of our potash. Potash is the most vulnerable to import supply problems. And when we look at those countries that we rely on for imports, or those countries that are major exporters, so Canada, of course, we are it's important that we are able to get, you know, a large majority of our potash needs from them. But when we think about some of the other players in the world market for potash is Russia and Belarus. And then, as I'll show in just a second, Israel's also in the top 4 exporters of potash. So we think about what's happening in those regions, and if conflict expands, you know, what that can mean, and how that could impact, you know, the world supply and demand flow. So again, Israel, 4th largest global exporter of potash. So far, the war doesn't seem to be having impacts on manufacturing or shipment, but certainly something to watch. Another thing to point out here is that when we have conflicts and wartime situations, global energy markets tend to place some premiums into values pretty quickly. And another situation, Israel itself is not, you know, a major producer, exporter of urea, but we look at the region surrounding Israel and what could happen if war spreads to other areas in the Middle East and the impact that could have on fertilizer. This map here is from Joshua Linville's at StoneX, and it's showing, you know, this region accounted for over half of the global urea exports. And again, we're not really reliant on imports of nitrogen, but certainly think about the disruption that could have in the world market for fertilizer if that war did expand. And then oil prices here, you know, oil prices had been coming down in leading up to the early part of October, as some of those supply fears that had come. Some of the moves by OPEC Plus earlier had led to some supply fears, but then, you know, as signs of U.S. demand loss were coming on board, that price was starting to fall. And then very clearly, we look at October 7th when the Hamas attack happened, oil prices have a sharp increase, and then sort of plateaued for a while, but have since in recent days continue to track upwards. And so we think about the outlook here, again, just depends on what happens with the Middle Eastern region. You know, if war expands, if Iran gets involved, what all materializes there. And then just a few quick things on the macroeconomic side. This is showing the consumer price index, which is one measure of inflation. This tends to be the inflation measure that gets the most mainstream media attention. The Federal Reserve tends to use the personal consumption expenditures index measure of inflation as their primary measure, but the trend here is the same no matter which one you're looking at. So essentially, we've seen you know, inflation decline pretty significantly from that 9.1% peak in June 2022, but we have retreated. We hit down at 3% a few months ago and have increased again to 3.7%. I mean, I think a concern here with inflation is when we think about oil prices, you know, and the impact whatever happens in the Middle East may have. Does that result in a resurgence in inflation? One thing I will note is that, so I guess before I do that, the average inflation from 83 to 19 was 2.7%, and then the Federal Reserve inflation target rate is 2%. We're still above that, and we're currently moving in the wrong direction. The Federal Reserve does like to look at what they call core inflation, which is without food and energy. So when we think about the impact of energy prices, you know, in terms of the core inflation rate, that doesn't matter, but the flow through impact on the economy could also come into play. And then, so what does all this mean for what the Federal Reserve might do? This shows the changes in the Fed funds rate. The horizontal axis is the months of the rate hike cycle, and then the vertical axis represents the cumulative change in the federal funds rate. So dating back to March 2022, the Federal Reserve has raised rates by 5.25%. And so they were initially pretty aggressive and then have since plateaued. There's some debate as to whether we will see another 25 basis point increase at the November or December FOMC meeting. But like I mentioned, Chairman Powell has a speech tomorrow that may give some indication as to what they're thinking. I'll also talk about bond rates here in a second to wrap up. But that also kind of comes into play on this. One thing I want to note is the FOMC at their September meeting. So at every meeting, or at several of the meetings, they release a projection of the dot plot of their range of projections for the coming years. And so I'm showing here the upper end and the lower end of the FOMC participants' range of projections for 2024 and 2025. And if you went back and looked at this slide from the presentation I did at Corn Congress this summer, the lower end of these ranges is now higher than it was then. Basically, they've tightened up, with the lower bounds being higher than they were before. And it kind of goes along with the narrative we've been hearing a lot lately about, higher for longer, is sort of the outlook for interest rates that we're seeing. So not necessarily going much higher from here, but staying at this relatively higher level for longer. My slides aren't wanting to, here we go. Okay. I jumped ahead too far. So my slides weren't wanting to move there for a minute, but another thing I just wanted to wrap up here with is the Treasury yield spread. This is the spread between the 2-year and the 10-year Treasury note. And this is a recession indicator. It's accurately predicted every recession since the 1950s. This spread first inverted in summer of 2022. So we've been at this inverted level for a while. We hit 1.07 in March, which was the widest inversion since 1981. And then we retreated to a less inverted level. And then just in July, we hit 108 again. Negative 1.08, excuse me. And then currently this is at negative 0.36. So the spread has the inversion has gotten less inverted. But one thing I want to, and so some macroeconomists that I follow or listen to have said that this means that, the recession is less likely, depending on who you ask. Some think recession still imminent, and others think that we are in for a soft landing. I think that the whole situation in the Middle East has definitely thrown a wrench into anyone's projections, regardless of where they were before. But I want to note that when we look back over, these gray bars represent recession periods. When we look back over some of the recent recessions, we see that we do actually move back to a positive level typically before the actual recessionary period starts. So I do think that, if we did continue to see improvement in this spread, that, doesn't necessarily mean that we are out of the woods yet. Another thing I want to note is the reason that this is also important is because what's happening right now to cause this spread to become less inverted is that the 10-year Treasury yield is increasing faster than the 2-year Treasury yield, but they're both increasing. In fact, the 10-year Treasury yield's at the highest level since 2007. And so what's interesting about this is that it actually acts as a similar curve on the economy as a higher federal funds rate. So because of this action, it's possible that the Federal Reserve may take an approach where they don't see a need to raise. But of course, again, the situation in the Middle East is also a wild card. So that is where I plan to wrap up. At this time, I'm happy to take any questions. I never saw anything come in the chat box during, but if you raise your hand now, Jeremy can unmute you and give you a chance to ask a question. Otherwise, my email's here, and I'm always happy to respond to questions that way. Or if you have something on your mind, I always welcome those questions. So, Jeremy, do we have anyone raising their hand?
Right now, no.
Okay.
Thanks again for that presentation. Okay, we've got one raised hand.
Yep.
Nancy, I'm going to allow you to talk.
Hello, can you hear me?
Yep.
So I just want to ask you real quick. The one slide about Ukraine exports, I think it didn't really look like there was a significant, I guess, decrease over the past few years. But I guess my understanding was obviously the Russia-Ukraine war has impacted their ability to produce and export. So can you maybe explain what the data is actually saying for Ukraine over the past few years?
Yeah, so Ukraine, certainly, if you look at like the monthly exports, Ukraine, there was definitely a period when so Russia first invaded Ukraine in February 2022, and then we had a period of several months where Ukraine was basically exporting nothing, and then the Black Sea Grain Deal initiative was started that summer, and then Ukraine was able to export quite a lot. So that's kind of what I was saying, is that we've had this impression of Ukraine's exports being low, but they actually have been able to get quite a lot out. Another factor coming into play here is that they had a record production in 2021, much higher than they had produced prior to that, and so they had a bunch of stocks. So once that so even though their production in 22 and 23 is lower, it's actually not as low as you may expect. And then also they had the stocks from 21 that were stalled for several months, but then with the Black Sea Grain Deal, they were able to keep moving. And so then since the Black Sea Grain Deal was not renewed a few months ago, there was this initial thought that they weren't going to be able to get grain out, but then they found other pathways to be able to export. And so I don't think that ended up being quite as detrimental either as maybe what was thought. They basically spent the whole year that the Black Sea Grain Deal was in effect, making plans for increasing, doing some dredging on the, I'm probably not going to say it right, but the Danube River, and exploring some of those. They've been making infrastructure improvements to have other pathways to export.
Thanks, Krista, and thanks, Nancy, for that question. Anybody else? Raise your hand if you've got a question. I've got one from Kevin Suter. Kevin, unmute yourself and you can go ahead.
Hey, Krista, can you hear me?
Yep.
Hey, great presentation. I just had a question kind of to dovetail with Nancy. I've been struggling here to express the importance of biofuels, and in that, a marketing plan is not hoping for a drought, and a marketing plan is not thinking that a war in Ukraine is going to last forever. So I just was wanting to know, if to dovetail with Nancy, if the war in Ukraine were not happening, how would that impact our price of corn here? Or maybe you can't answer that, maybe it's too broad, but I just wanted to share that thought.
Yeah, that's a good thought. I mean, I think that so kind of as I was saying before, we haven't seen the reduction in that region as maybe what would have been expected. Certainly, there's been challenges there, of course. And so, where would we be at? Like I said, Ukraine had a very significant year in 2021. So if we think about what trajectory they might be on, now 22, 23, 24, if they were kind of continuing in that pace in terms of corn production. I mean, it's hard to say how that might impact our corn price, but certainly, it seems like there could be more corn on the world market. And I think that, all this, the reality is that we're seeing, I think that kind of like I pointed out in some deeper analysis this summer talking about Brazil, Brazil is definitely going to be a significant corn producer and exporter. I think that depending on what the margins dictate, and especially with corn being most of the corn being a second crop there, we might have some years where they're higher, some years where they're lower. but overall the trend is more corn on the world market. And so we need to be thinking, like you said, more deeply about what is the marketing plan. The marketing plan isn't hoping for production problems in a different area or other types of the situations, but thinking about what we need on the demand side to continue to have U.S. corn be, a viable, have viable uses and users of that product.
Thank you.
Thanks, Kevin. Anyone else with any questions? Feel free to raise your hand. Doesn't look like it, Krista. If not, you want to close us out?
Yeah, well, thanks so much for listening in today. And thanks to those of you who did ask questions again. Feel free to email me anytime if you have other questions. With that, I guess if there's any farmers who took time to listen, I know we some board members might be on here. Good luck with the rest of harvest season, and wishing everyone a safe remainder of the harvest season. And thanks again for listening in.
Thanks, everybody. And one thing we forgot to mention, we are recording this, so we will get that out to everybody that registered and share widely. Thanks.